the DeFi dictionary, the decentralized dictionary. These are some must-knows before you enter the DeFi space. DeFi, this is one of the hottest buzzwords right now in 2021 in the crypto realm, and rightfully so. The potential of decentralized finance is enormous. A first glance shows it's extremely disruptive. How else could it be possible to earn a 500% annual interest rate on a yield farming account? The first question that comes to mind is what 500%? How's that even possible, let alone sustainable? Industry veterans have seen it all before. The last time was in 2017 when ICO investments or speculations returned between 10 times and 1,000 times before the whole market collapsed into a prolonged crypto bear market that's been going on for the past 2 years now. As prescribed by behavioral finance, the vast majority of people flock to a new trend when it's actually time to get out. Many new latecomers to the 2017 ICO boom didn't see a 10 times return of their portfolio, but rather a minus 80% or worse. It's simple market dynamics, but nothing beats psychology. What also didn't help is that the vast majority of projects were scams or lacked the right mix of team, vision, implementation to build out what they had promised. So yes, do your own research and let people like me help you provide you with a framework to understand the fundamentals, questions, and exclamation marks. DeFi is promising. DeFi is full of risk. DeFi is everything at the same time right now, but in the greater scheme of things, the advent of Bitcoin in 2008 and the ensuing development of the crypto world in the past 12 years were the first steps to introduce a non-traditional way of thinking about and interacting with finance or new technology. Since then, the crypto realm has continued to evolve at an exponential rate. With newer cryptos and blockchain technologies consecutively merging, DeFi is the next stage. It sits at the forefront of innovation in today's blockchain space and won't hold back to disrupt every financial service it encounters. Meanwhile, DeFi popularity has skyrocketed with its market cap in November hovering around $11 to $12 billion, an impressive growth compared to the $1 billion back a few years ago. And that leaves the question, what exactly is DeFi and why are so many people talking about it? So what is DeFi? One of the main aims and purposes of cryptocurrency is to make money and payments universally accessible to anyone, anywhere, and DeFi takes this a step further by making other traditional financial services, savings, loans, trading, insurance, and more accessible to anyone around the world. Through decentralized technologies such as cryptocurrencies and decentralized apps, or DApps, anyone with a smartphone or supported wallet and internet connection can utilize a variety of financial services that they may not have access to through traditional means. In other words, the development of DeFi has expanded the use of blockchain tech from simple value transfer to more complex financial use cases. Almost all DeFi applications are built on the Ethereum blockchain, the world's second largest crypto platform like Bitcoin, after Bitcoin. Ethereum is primarily designed for creating and executing smart contracts, which makes it flexible and easier to build other types of DApps beyond simple transactions. Smart contracts are programs running on the blockchain that deploy automatically when particular conditions that are written into it are met. As a simple example, a smart contract can be programmed to release funds to another user for Christmas each year. But smart contracts can also enable developers to build sophisticated DApps that provide functions beyond sending and receiving cryptocurrency. DeFi DApps can create stablecoins, lend out money, and earn interest, take out a loan, exchange one asset for another, or even implement advanced automated investment strategies. Moving on to the DeFi suite. Some of the most popular types of DeFi applications include 1. Decentralized exchanges where you own your own keys. A DEX allows users to buy and sell their crypto with one another directly through a smart contract on the Ethereum blockchain, without a central authority. It effectively cuts out any middleman, especially centralized crypto exchanges, so users can regain control of their finances and no longer need to entrust their money with governments, financial institutions, or central banks. Decentralized exchange platforms such as AirSwap Team, Bancor, IDEX, and SushiSwap all have slightly different architectures. One of the most popular DEXs at the moment is the decentralizing trading protocol Uniswap. Uniswap is a fully decentralized cryptocurrency exchange that uses automated market making to automatically settle trades and lets users trade popular tokens directly from their wallets. In an unprecedented move to show gratitude to their early community members, Uniswap conducted an airdrop in October, giving away 400 UNI to each address created before September 1st, 2020. That conducted at least one transaction on Uniswap V1 or V2. At the time, 400 UNI was worth between $1,600 and $3,200, and currently hovers around $1,000. Users with multiple addresses have really benefited from this unexpected gift. Furthermore, in the latest version of Uniswap, UNI token holders will receive a percentage of each transaction that goes through the platform. Moving on, borrowing and lending, higher yields, lower costs. Arguably the fastest growing sector of DeFi, borrowing and lending platforms connect parties through smart contracts rather than leaving the management up to banks. Lenders can provide loans to businesses or deposit money and earn interest as others borrow their assets. Since middlemen are cut out of the exchange, lenders are able to earn higher returns. Compound is an example of a popular blockchain-based borrowing and lending DM. Users can lend out their crypto and earn interest on them, or deposit cryptocurrency to the Compound smart contract as collateral in order to borrow funds. Due to its decentralized nature, users don't have to specify their personal details, name, financial history, etc., and their collateral is enough to get a loan. The borrowing and lending rates are algorithmically adjusted based on supply and demand. Stablecoins, instant processing and lower volatility. Stablecoins are less volatile cryptocurrencies as their price is pegged to a reserve asset such as US dollar or commodity like gold. Combining this elimination of doubt over value volatility with instant processing and the security and privacy of crypto payments, they offer a strong value proposition. Wrapped Bitcoin WBTC is one of the top DeFi tokens by market cap, in second rank with a market cap of approximately 1.6 billion at the time of writing. WBTCs are a method of sending Bitcoin to the Ethereum network so they can be used directly in Ethereum's DeFi system. It allows users to earn interest on the Bitcoin they lend out via decentralized lending platform. Prediction markets, bet with lower fees and better odds. Decentralized prediction market protocols allow users to bet on the outcome of future events, such as elections, without intermediaries. Traditional betting platforms tend to maximize the amount of value they extract from customers with high fees, low odds, and all sorts of limitations. Blockchain-based prediction markets like Augur and Guesser are changing this by providing a decentralized peer-to-peer exchange that enables global and transparent access to the markets. Users keep more of their winnings due to lower fees and better odds. An observation from CoinDesk points out that DeFi has the potential to boost interest in prediction markets since they are traditionally frowned upon by governments and often shut down and run in a centralized manner. No loss lotteries. Play the lottery without losing your money. Another DeFi service includes participating in no loss lottery. Pulled together is a no-loss game where participants deposit DAI stablecoins into a common pot. At the end of each month, a lucky participant wins all the interest earned and everyone else gets their initial deposits back. Synthetic assets, bet on real-world assets without holding them. Synthetics is a token trading platform built on Ethereum that allows users to create and exchange synthetic versions of real-world assets. It allows users to bet on crypto assets, stocks, currencies, precious metals, and other assets in the form of ERC20 tokens without holding the actual asset. Robo-advisors, automated smart contract-based investment portfolios. Although relatively nascent to the DeFi scene, investors in DeFi can generate the highest possible yields with the help of robo-advisors. Investors would normally need to keep an eye on contracts and quickly reallocate in order to get the best yields. But now a robo-advisor designed and set through a smart contract can conduct the monitoring and allocating for investors. For example, an investment pool with $5 million worth of ETH, Ethereum, and it will automatically be moved to a platform that offers the highest percent for collateral on ETH-based derivatives. Stakes, robo-advisor for yield, Ray and Rary Capital are two popular robo-advisors that automate the process of finding high-yielding opportunities. Ray targets investors holding Ethereum, USDC, or DAI who can put their assets into a pool and let the smart contract automatically invest the pool or part of it into contracts with the best yield. Now, what is the craze and why is the craze? The DeFi craze and its exponential growth has been powered by its potential benefits and without a doubt that ever-present fear of missing out, or FOMO, of DeFi can be attributed to the mind-blowing high yields promised by yield farming projects, which play on the human weakness and desire of getting rich quick with little to no effort or responsibility. Yields from yield farming projects can range from a hallucinatory 500% to a low APY of 0.57% with plenty of projects in mid-range. The lure of high rewards is hard to resist in enticing many to flock towards DeFi and yield farming without understanding the risk involved. However, let's put the risk of DeFi on the back seat for the moment and consider the many benefits and advantages that make DeFi so compelling. First, decentralized, quick smart contract deployment with little to no human intervention and at a reduced cost. The decentralized nature and cutting out of middlemen from all kinds of transactions is one of the primary advantages of DeFi. Since smart contracts, rather than centralized systems or human gatekeepers, are at the center of DeFi operations, they can be deployed quickly and run with little to no human intervention at a reduced cost. The lack of middlemen also means that users don't need to entrust their money to third parties and that they are therefore empowered with direct control over their funds. Secondly, transparent. One can verify any and every transaction that focuses on the blockchain. DeFi codes and transactions are transparent on the blockchain for anyone to view or audit. The transparency builds trust with users since anyone has the opportunity to verify and understand a contract's functionality or find bugs. Although transaction activity is public for anyone to view, they are pseudonymous by default, so a user's private detail is also protected. Thirdly, global, permissionless, and inclusive, anyone, anywhere, and anytime. DApps are designed to be global, permissionless, and inclusive. This means that anyone, anywhere, and anytime can access the same DeFi services and networks as long as they have an internet connection. Unlike traditional financial services that require you to fill out lengthy forms with personal details and have limitations, anyone can create and use DApps from their crypto wallets. Interoperable. Open source enables Lego-style composability. The codes behind DeFi apps are open source and public for anyone to view, so anyone can compose new apps with code as building blocks. The composability of DeFi leads itself to infinite possibilities as DeFi apps can be put together like money logos to build new financial products. For example, a user can buy the stablecoin DAI and then lend it on Compound to earn interest. 5. Opportunity to earn. Higher interest at lower costs. Interest rates from central banks worldwide sit at pitiful numbers and seem to just get worse as the years go by. The current American interest rate is 0.25%. British is 0.1%. And European interest rate is 0.00%. In contrast, DeFi uses the opportunity of earning through interest from lending platforms or yield farming. Since middlemen and central banks are cut out of any operations, users tend to earn higher interest. And moving on, challenges and risks. Make no mistake, DeFi is risky. Despite the benefits that the DeFi ecosystem has exhibited and the potential it has to unleash, it's not without risk and challenges as a young financial system compared to the traditional ones we're used to. The entire crypto world is still developing in the process of ironing out its wrinkles, and this takes time and means that it's important to understand the risk present in today's DeFi. Immediate flashback to the 2017 ICO boom comes to mind. The ICO boom of 2017 took the crypto market by surprise as it generated over $6 billion, 4 times more than what was generated between 2013 to 2016 combined. ICOs revolutionized crowdfunding and helped crypto startups attract a record number of funds with a minimum amount of accountability. And yes, a never-ending list of. This resulted in a large portion of projects reportedly operated by scammers, while many other projects crashed and burned when they failed to deliver positive returns for investors. DeCoins has recorded that 780 coins were scams and over 1,000 coins have died out. And yes, another parallel with the current DeFi craze is, well, the crazy names. If one thing is clear in hindsight, it's the 2017 ICO hype was short-lived and the entire crypto realm crashed right into a bear market in the beginning of 2018. And no wonder concerns are growing as to whether the DeFi craze will be a repeat of the past, with projects dying out and many people likely losing a lot of money. And moving on, smart contract bugs, devastating vulnerabilities. As with anyone that exists online in the digital world, smart contracts are vulnerable to both unintended programming mistakes and malicious hacks. Hackers that find bugs in open source code for a DApp can easily exploit them, resulting in the instant draining of millions of dollars. A great example of the past is the parity hack, where over 600,000 Ethereum was lost due to a bug in the smart contract. The most recent prime example is the Harvest Finance hack on October 26, where 24 million was drained from Harvest Finance stablecoin and Bitcoin pools in less than 7 minutes. The hack resulted in Harvest Governance token farm plummeting 60% and 400 million in total liquidity drained as liquidity providers fled the platform. Although smart contract bugs and vulnerabilities are risks, teams like Nexus Mutual are building decentralized insurance to cover users in the event of smart contract hacks or failures. Next risk is yield farming. Huge yields at huge risk. Yield farming is arguably the buzzword behind the explosion of DeFi. The concept of yield farming emerged from the DeFi movement as a new way of earning impressive yields on cryptocurrencies. And the next thing is differentiating good and bad projects. It's difficult for general users to separate good DeFi projects from the bad, resulting in many users getting scammed by fraudulent projects or investing in projects doomed to fail. A quick search on the internet will reveal plenty of horror stories from people who have lost thousands overnight or who have been subject to farming scams. One guy just lost 140,000 worth of Uniswap tokens to a fraudulent yield farming project. And there have been numerous failed projects already, and the sad reality is that there will likely be more to come with this ICO. So in conclusion, blockchain and the latest buzzword DeFi are at the forefront of today's financial innovation. With, on the one hand, hallucinatory yields of up to 500% annual, and on the other, exploited smart contract vulnerabilities that can kill a project overnight. It is clear that we are still in the early days, but the promise is real, and there are many people and projects striving to build a better global financial ecosystem. The dream is that anyone, anywhere, anytime can have seamless, secure, and low-cost access to payments and remittance, borrowing and lending, savings account, wealth management, and more. DeFi will continue to grow and redefine the standard of finance as we know it.